Welcome everyone to the new episode on the Indian Market Outlook 2025. In this video, I'll be covering three aspects of the Indian stock markets. I'll be walking you through the sentiment that is currently prevalent in the market. I'll also be giving you a perspective on the current liquidity scenarios, liquidity conditions prevalent in the current macroeconomic environment, and then I'll be taking you through some of the other macro trends which are very important as we move into the next 2 quarters for the next year 2025-2026. Okay, let's begin. So before I give you my perspective on those three pillars of sentiment, liquidity, and macro events, let's quickly recap how the market performed and how it behaved from January 2025 till date. It, to, it has been a year of strong resilience, and it was primarily driven by healthy earnings. The inflation has moderated, and as we speak, it has the retail inflation has numbers has just come out, and it's quite low in the range of 0.25 to 0.5%. And what this has done is it has done a renewed investor. It has brought a renewed investor confidence in the entire market. Moving on, at a high level, the way we can think of the year which has passed by 2025, it was a year of high growth and low inflation. So we saw a growth above 6.5, and in fact in the April to June quarter it touched close to 8%. The inflation, as you see, it's quite low, it's below 2%, and it has been a multi-quarter low value, a low number. So what's the takeaway? Takeaway is this is a rare combination of high growth and low inflation, and these two combinations really support the growth of the stock market, right? And that is what we will be see in the next few quarters. Okay, let's talk about the first pillar, which is the corporate earnings. So there are four or five observations which I have gathered analyzing the based on the analysis of the quarterly earnings for the last 3 quarters, and I have reviewed mostly the Nifty 500 uh, quarterly earnings, the stocks under Nifty 500 and their quarterly earnings. So what do we see? We see, number one, margin expansion, where the input costs fell, and as a result the operating leverage kicked in. The second observation was, we in most of the sectors we saw an optimistic commentary and an optimistic guidance from the management. Uh, and we saw that in the autos sector, in the infrastructure sector, in the banking industry, as well as in the consumption sectors. And in fact, autos and consumptions had a more tailwind event, which was the rationalization of GST into three buckets, and the benefit was subsequently passed on to the end consumer, and that's what we saw in the improved and revigorated number in the auto sales and in the consumption uh, sales. The third observation uh, was the analyst upgrades. So what we saw was the number of stocks on which the analysts upgraded their outlook. It quite outnumbered the number of downgrades for which the analysts uh, outnumbered the number of stocks for which the analyst downgraded their let's say outlook or ratings, right? And this was observed for the first time in last 2 years. So if we take uh, the data from 2023 till 2025, this was the first instance where similar kind of an uh, observation, or let's say similar kind of a uh, 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 observation similar kind of observation was seen, right? The fourth aspect is as we are entering the year 2026, uh, most of the companies are showing a strong balance sheet numbers with a low leverage and improving pricing power, right? So this combination is quite is positive in terms of what we can forecast or what we can expect in the next 2 quarters. Moving on, I'll be now covering the liquidity conditions in the current market environment. So, starting late last year, in fact, in the year, in the quarter, in the fourth quarter of year 2024, in the fourth quarter of year 2024, and subsequent quarters, we have seen lot of uh, steps being taken by the Central Bank of India, which is the RBI, and it has always maintained an stance which was accommodative in nature, meaning based on the inflation and the growth parameters, they are quite open to to reduce rate cuts, and as well as they have made lot of banking reforms, which which essentially translates into putting more cash in the at the hand of the banks, right? So that's number one uh, 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 observation which we have seen consistently since last 4 quarters. And based on that accommodative stance of RBI, what that has translated is the repo rates have I mean they have they've reduced the repo rates and the interest rates twice in last 4 quarters. And in terms of their guidance, their outlook, the tone has shifted uh, towards easing and cutting and having more rate cuts if required. And that has also translated into stable bond yields in the Indian bond markets. Uh, that's again being driven by strong macroeconomic and strong balance sheets of the Indian government, with a controlled current account deficit and a controlled fiscal deficit, and a reasonably predictable growth rate. So all these factors uh, has stabilized the Indian bond market yields, and it's quite positive as we move forward, or as we look into next few quarters. So this covers the liquidity environment, or liquidity conditions in the current environment. Now let's move on to the uh, next section. So this before we move to the next pillar, which is the macro environment events. So as you can see, the 10-year Indian government security is quite stable for last 2 months. So from October 25 to December 25, if you see, it has quite stabilized between 6.75 to 6.5, in that range. Before that, in the preceding 3 quarters, there was some fluctuations of the 10-year GSEC bond yield, but since last 2 months, it has stabilized a lot. And the third pillar, which is related to the Indian macroeconomic uh, conditions. So it has three significant uh, anchors. The number one anchor is we are observing a robust growth, nearly 8%, and as I talked it in the earlier slides, so it's quite near to 8%, and it's being driven by domestic consumption and improved revenue seeing in the services industry. The second anchor point is a low inflation. So what we are witnessing is a multi-year low inflation, and that is easing the cost of capital for the industries, and it will translate into a better revenue growth, and in fact better profitability and the net profit margin. And the final anchor for the Indian macroeconomic environment is the fiscal path. As you can see, the fiscal year 2026 budget, they were targeting a fiscal deficit of 4.4%. So currently it is at 3.5%. So we can expect some capex funding being sponsored by the government balance sheet, right? So given these three conditions, we expect that the robust growth will continue in a inflation environment, and government coming and uh, doing more capex, right? So all these three are again a positive outlook, and we can expect the stock market to give a positive, let's say, reaction to these events. So I have tried to simulate or capture three scenarios. The best case scenario, as per me, it has a 60% probability of occurring. The best case scenario. In that scenario, we will see a steady growth, which is close to north of 6.57%. The inflation will be controlled under, let's say, 3.5%. There is moderate upside. So what does this signify? This signifies there is moderate upside for the financial stocks under financial sector, capital goods, and in the consumption sectors. The second uh, scenario which I have captured here, and which I think has a relatively low probability of around 30%. Uh, so under this scenario, if the government security yield, 10-year government GSEC, Indian 10-year bond yield rises to north of 7.25%, and valuations compressed by 5 to 10%. So in that case, it would be wise to take bets and defensives, which includes FMCG and pharma sectors, rather than the high beta, or let's say other high beta sectors, right? And the final scenario which I have captured is the tail risk, which includes external shocks, uh, and this scenario can occur because of any unforeseen uh, events happening at a global level. It can be a war between two countries. It can be uh, a war which is currently going on and it becomes worsening the warlike situation, or it could be any other new, let's say, tariff related news which impacts the global supply chain, and the overall uh, global economy growth. So in case of these external shocks, where I have captured the sudden spike in the oil, because oil has been in the low range, below 60, below 70, in that range, dollar per barrel, in that price range for a long. And there is a scenario where if the oil prices rise, then the overall inflation rises, and then it affects the overall growth of the global economy. So in that case, in these kind of external shocks, these global risk of can trigger a lot of volatility, and capital can outflow from the emerging markets. So in that case, uh, uh, all the positive aspects of the Indian economy, all the growths, low inflation, and the fiscal prudence seen in the Indian macroeconomic might not benefit the Indian stock market to a greater extent. So finally, I will. This is my sectoral view for the next 2 to 3 quarters. It's overweight. It's being overweight on the banks and financials, capital markets and infra, autos and quality mid caps, and I would I would be underweight on export oriented IT services, chemicals, and rate sensitive utility sectors and industries. So as a retail, how you should strategize your portfolio and investment strategy. So either you can park and wait. So meaning, so what that means is you can build your exposure in short duration debt funds or liquid instruments as a parking space. Keep your cash ready in case there is some global shock or those kind of events where you see a sudden 10 to 15% dip in the Indian market, Indian stock market at the index level. And in that case, given the positive macroeconomic environment, as well as the growth which we are seeing across the Nifty 500, and in general all the corporate sectors, all corporate companies across all sectors, the growth which you are seeing, so that will support the Indian stock market and the index in general to fall below, let's say, 10 to 15%. So treat that as an opportunity whenever, if you get similar kind of an opportunity where the index falls 10 15%, so have the cash ready and gradually build your positions in the sectors which I had shared uh, a few slides ago. And and that should be your let's say strategy, portfolio building strategy and investment strategy for next two quarters. So before I close, these are my closing thoughts. So as India enters the year 2026, we see a rare alignment of disinflation supported by robust growth as well as steady liquidity. So given all these conditions, we should be hopeful of a market which will uh, reward who build the gradually, who buy on dips, and who takes those sectoral bets which benefits from all these macroeconomic conditions, improving liquidity condition, as well as the focus of the capex from the government of India. So keep watching the CPI trends. Keep keep a track of the RBI announcements which come from time to time, and keep a track on the bond yields. So with this, I would like to to uh, thanks everyone for watching the video. And if you found this analysis helpful, hit like, subscribe, and share it with your fellow investors. Stay informed, stay disciplined. Thanks.